Today. So it's a busy day, and of course there's the big one, which is Reliance Industries, which also should start up in just a bit. I mean, the opening itself, right? I mean, given the global backdrop is more than anything that one can wish for. It's all 1.5% cuts on global indices. Here it got a higher start, so 30 points higher. Outsized impact from Infy, I'm assuming. But 24,822. Nifty Bank is, of course, has been the weaker of the two indices. It's down about 100 points. And we're at about 52,500. Yeah, there you go. We've got mid-cap index, which is up about 1/3%. Stocks at about 56,900. And many other names are also starting I mean, actually, look at the advanced decline is very evenly matched. 800 up and about 757 stocks, which are slightly lower. So it's almost 1:1 at the word go, but all about stocks. Surabhi.
Absolutely. Infosys 3% higher. LTI Mindtree is still continuing its good form from yesterday, 1% higher. HCL Tech, Wipro, TCS. But guess what? Beyond that, things are completely fizzling out. Some consumer names are still retaining a tinge of green from yesterday. Nestle and Tata Consumer, Britannia would be a case in point. But otherwise, the market is reeling under some profit booking. Some of the metal names like Hindalco, Tata Steel, JSW Steel, they are down about 1.5%. Power Grid and Ultratech Cement are some of the weakest names this morning as we start off. There's BPCL, NTPC, so fair bit of PSU. Coal India, ONGC, a lot of PSUs, which are shaking off some of the exuberance of the last couple of weeks. So that's how it is, 33 down on the Nifty right now. Let's look at what's happening to the bigger banks. HDFC Bank is flat. ICICI Bank is down about 0.5%. SBI is also down about 0.5%. So banks not providing any support at this point in time. And Reliance is also quiet ahead of numbers, down about 0.3%. But I guess, Nigel, the bigger story once again is in mid-caps. I mean, and like yesterday, we had the big, wobble, the shakeout yesterday. Even right now, mid-caps underperforming at the start.
Well, as you all did that market check, the Nifty has come off 100 points from the high point of the day. So there's been a bit of a sell on the opening in today's trading session. And the mid-caps, they are the ones that are pulling back. You have nearly two stocks that are declining for one stock that's advancing. Let's see how that goes. The sector that's coming for a clonk today is actually the tire space. CEAT came out with its set of numbers. Margins continue to remain under pressure. The hope is that they've taken a couple of price hikes, so hopefully things improve from here on. We'll get chatting with the management in just a bit. That's down 0.5%, but Apollo Tyres is down close to 6% as we speak. So big pullback on that one. Balkrishna Industries as well as down close to around 2%. And you had MRF that's pulling back by 2.5%. So the tire space has come in for a bit of a knock. Persistent Systems, the top line growth was okay. The problem was on margins. The street hasn't taken that kindly. That stock is down closer to around 6%. LTTS had started off in the red, but that dip got bought into, so the stock is now down only around 0.2%. What's doing well? South Indian Bank, I think that one as well came out with its set of numbers. That's seen a big uptake in today's trading session, so a pop is what we're seeing on South Indian Bank. Indus Stars, we had highlighted this yesterday as well, that from the telecom pack, it appears this one looks best placed. And that one, in fact, yesterday was higher. Today as well, it's moving a little bit higher. MTNL is moving on hopes that maybe some kind of a package or something moves in the right direction for them. The other stocks that are unfocused, the Dalmia Bharat opened up well in the green. But that's, sold off actually from the high of the day. It was up close to around 2%. And after that gap up, the stock is now down close to around 1%. So clearly the street believes that there is some kind of a one-off in these numbers. And those numbers couldn't be that good, given the kind of pricing, the kind of volumes that they reported.
JSW Infra is also a weak one, again reacting to numbers. Yeah, but the margins cooled off a lot. Margin fell almost 10 basis points. 61% became 50% in this quarter. Stocks down about 4%. So some result reactions playing out. Persistent is now down about 6%. So sharp reactions there.
No, absolutely. And, market's down about 55 odd points or so. I just want to highlight one more thing. You look at the Nifty Alpha Index. So the Nifty is, actually with a 50-point cut, it's what? A quarter percent, not even a 1/4% down, right? 0.2%. But look at the Nifty Alpha Index, which is essentially the high momentum pack. And I was highlighting this yesterday during the closing hours as well. That's down a full 1%. So that is telling you something. This is the high momentum part of the market where the cracks are emerging in a much more significant way. So broader markets, yesterday's rally also in a way was a kind of a one-trick pony. IT was the sort of, big leader. Today, once again, I think a lot of it has got to do with what Infy and maybe a couple of other IT names are doing. But more stocks coming through in just a bit. So Persistent, I think we mentioned bulk of the big ones. Apollo is down 7, Persistent is down 5, Chennai Petro is down 8%. It's got very large volumes for this point in the day. Oil India is down 3, JSW Infra is down 4, NLC India, Borosil Renewables. I go down the list, but the volumes will start to dry up here. And on the upside, market breadth is clear slam dunk negative. 1,600 stocks are down and 500 stocks are up. That is market breadth. This is still very early, but it gives you an indication of how things are kind of sitting very, very early in today's session. On the upside, IREDA is up. Torrent Power is up 2%. Cyient has got some gains. VST Industries is a big one. That's a 10% mover on VST. Very large volumes coming through. So that kind of stands out at this point in time. But I think we have a market master ready. Nilesh is with us, Ruby.
Yes.
Just a couple of points. Chennai Petro has gone ex-dividend, I think so. So that's the reason why, in fact, the stock is low.
Okay, all right. So let's take this conversation forward with Nilesh of Kotak AMC. Thanks, Nilesh. Great to have you on. Pleasure. Busy season. Earnings, markets roaring, budget around the corner. So what do you make of things? And we know your view. You've been sort of asking investors to be a little cautious, but investors have a mind of their own, and this market has bought every dip up until now. How do you view the current market construct?
So there is a very great saying which says that markets can remain irrational more than you can remain solvent. So we have to respect market momentum. But when I was a kid in 1977, there was a movie called Amar Akbar Anthony. This market reminds me of Amar Akbar Anthony. Amar was an upright police officer. What is the quality stock? Reasonably valued stocks where there is high floating stock kind of signify. On the other hand, Anthony Bhai was Chalta Purja, naughty, mischievous, far more entertaining. There are many stocks which are in momentum, where floating stock is limited, where valuations are sky high. It's entertaining, undoubtedly. But we all know, in the end, Anthony Bhai has to converge to Amar and Akbar and become upright. I think it's time to buy Amar Bhai equivalent stocks. Try to slowly take profit from Anthony Bhai equivalent stock and wait till such time they join the bandwagon of Amar and Akbar.
Nilesh, you always have the best analogies. I don't know how you come up with them, whether you think it through or whether it's spontaneous, but it is literally the best. And it sort of explains the point so well. The issue right now is that, Amar Bhai has been sort of walking a very lonely path for a while now, and I'm talking about FMCG stocks or even banks for that matter, because a lot of people feel that Amar Bhai doesn't know how to run. So you have to leave Amar Bhai aside and think of maybe Akbar or Anthony. But to come back to the more serious point, IT has started delivering. We are seeing, first signs of perhaps a bottoming out over here. What about banks? What about FMCG? How much would you allocate to these in the portfolio now, given the market?
I think both these sectors have underperformed market for some time, and valuations are fairly attractive. We believe both these sectors have potential to outperform the market once momentum trade starts playing out. In FMCG, elections have given money in the pockets of consumers at the bottom end. Many of the state budgets are also putting more money in the pockets of consumers at bottom end. We believe budget will also provide boost to the consumption through investment in infrastructure as well as some direct benefit transfers. Monsoon is progressing on average monsoon, normal monsoon. Put all these things together, FMCG should start outperforming the market over medium term. Of course, within FMCG, you'll have to avoid those FMCG sector which is becoming like telecom sector, hyper competitive. Their profitability will go for a toss. You'll also have to look at those FMCG stock which is now catering to mass market products rather than just premium products. And most importantly, we are seeing unorganized sector bouncing back in FMCG with their innovative strategy. Who would have ever thought that a namkeen maker could command a very high valuation if gossips are to be believed. So innovation will be key, adoption will be key, but I think FMCG is one sector to bet upon over medium term.
We know our Amar Bhai for now. Nilesh Bhai, hi, good morning. Prashant this side. So, in two sessions today and Monday between now and the budget, right? That's the going to be the big talking point, and we'll of course look forward to getting your insights once the budget is out. But right now, I think we can, for a short bit, talk about what the expectations really are, right? And from a capital market point of view, there is always this talk about capital gains and what will happen to capital gains. But there are also nuances. For example, for the mutual fund space, one big category which has taken in so much inflow has been arbitrage funds, and which have done very, very well. Some chatter amongst taxation experts that we could actually see some we could see some changes to that category as well. Arbitrage funds right now enjoy equity taxation, and there is some chatter that that may change. I mean, we don't know, but I just wanted to sort of touch upon that. Your thoughts, Nilesh Bhai?
So, Prashant Bhai, many centuries ago, Kautilya mentioned that taxes should be collected like honeybees collect honey from the flower. I don't know whether Kautilya was aware of equity arbitrage fund or not, but definitely he hinted towards equity arbitrage fund. This fund gives investor perception that their income will be taxed at 15%, as majority of investors are in growth plan and keep money for less than 1 year. Arbitrage fund is classified as equity fund, and hence any earning of arbitrage fund in growth plan for less than 1 year is taxed at 15%. The government actually laughs all the way to the bank, because arbitrage fund continues to roll over their future position every month, and in that they pay STT. The STT paid in last 3 years in Kotak Equity Arbitrage Fund between FY22 to FY24 is 1.1% to 1.56% of our average AUM. As a percentage of return declared in FY22 to FY24, it is 18% to 22% of return. And more importantly, arbitrage fund is only one trade in the market. If I am going short future, there is someone else who has to go long future. Otherwise, my trade will not go through. So the market participants, the long-only participants, pay another 18 to 20% of their return by way of STT. Collectively, 15% STCG from investor, 18 to 22% STT from the fund, and 18 to 22% STT from the market. The average tax collection for the government from equity arbitrage fund is 51% to 59%. Average of last 3 years is 56%. Where else this Kautilya's example of collecting taxes like honeybee collects honey is better illustrated. So my recommendation to Honorable Finance Minister will be, you should devise more ways of taxing like equity arbitrage fund, where you get more than maximum marginal rate of tax of 39%. And more importantly, investor is happily paying. There are also advantages of equity arbitrage fund. It provides financing to the long-only participants. And many a times, thanks to market efficiency, long participants are borrowing at rates which are very, very competitive. Without arbitrage fund, do you think retail investors would have bought 21,000 crore in cash market on budget? Probably no. So arbitrage fund is the perfect example of Kautilya's way of collecting taxes, and we should devise more instruments in that.
Okay, that's an interesting point. I don't think, at least I didn't think of it that way. But yeah, that's staggering STT collection for the government. It's a win-win, as they say, right? But broadly on taxation, Nilesh, and I'm not getting into whether the 10% rate changes or not. From a mutual fund perspective, is there anything else that you would like to see? Because the debt blow was dealt about a year and a half back to the industry. Arbitrage is, hybrid is still a category where some funds still manage to get more efficient taxation. Any further tweaks that you would advocate?
So my only humble submission to Finance Ministry is that the tax incentive should be for the right opportunity. For example, Surbi, all of us would have put money into public provident fund account. Our parents taught us that from your first salary, please open PPF account. We did some calculation back of the envelope. If you had kept on putting 12,500 rupee every month for last 25 years, you would have put 37.5 lakh rupee in PPF account over last 25 years. PPF account interest is tax-free. The total value of that PPF balance from 37.5 lakh rupee would have become about 1.07 crore tax-free. On the other hand, if you had done same investment in SIP of an average equity-linked savings scheme, I'm not talking about the best performing equity-linked savings scheme, just average, the value would have become about 4.4 crore taxable. You remove taxation out, you still make 3 crore extra on 37.5 lakh rupee of investment between PPF versus ELSs. And markets have run up after I did that calculation. Now, where should our government give incentive? PPF is 15-year plus 5-year plus 5-year kind of investment. And we are giving incentive for long-term investment in fixed income. Shouldn't we be giving incentive for long-term investment in equity, which will create value for our citizens? How many Indians have 3 crore rupees as retirement package or as retirement kitty? Just one decision of choosing PPF over equity-linked savings scheme could have made that difference in 25 years. So my humble submission is there is lack of financial awareness among many Indians or most Indians. SEBI has done a fantastic work with mutual funds, sahi hai, but we have a long distance to cover. Our tax incentive should be for long-term investment, which makes India financially secure.
Okay, all right. I'm sure what you're saying is being heard.
The message is don't fix what ain't broken. So, I mean, just let it be more than anything else. Nilesh, by great conversation. Thank you very much. And I think those numbers put a lot of this, a lot of the arguments in clear contrast and perspective. So thank you for joining us. And as I said, we look forward to speaking with you once the budget is actually out. That is, of course, on Tuesday. I think the market's down about, what, 50 points or so, 24,753, guys.
Okay, let's move on. We have a corporate conversation now lined up. The stock in focus is CEAT. Now, it's been a mixed bag for the company in the first quarter. Revenue saw a healthy growth, but margins have fallen for the third straight quarter, impacted by higher input costs and rubber prices, which have been rising higher. To talk about the performance and the road ahead, we have Mr. Arnab Banerjee, MD and CEO of CEAT, with us. So let's start with the performance. Revenue up almost 9%, but your margins are under pressure. Is it just raw material? Is it something else? Do you see this pressure coming off?
Time. So when should
I think you're on mute.
Sorry about that. So good morning. The revenues have indeed taken off well, with double-digit growth in replacement and international market. These are the two profitable segments which have moved up now to 75% saliency overall. Margins are under pressure primarily because of input costs. I think we have doubled down on efficiencies because of our lighthouse implementation in Halol as well as Chennai. Manufacturing cost has come off well. It's primarily natural rubber, which is at a 13-year high within a short span of time. And as I had been mentioning earlier, if the inflation happens gradually, we can manage the margin easily. If it happens in a short span of time, like it has happened this time on the natural rubber front, it has an impact on margin in a quarter kind of time frame, because price increases which are happening with a lag.
All right. Hi, sir. Good morning. Nigel on this side, and good to see you in. Give us a number, the average price of rubber for the past quarter. I think it was hovering around 150 per kg. Then it went to around 190 per kg. So what's the average for quarter one? And at current reckoning, what is it?
So it's close to about 185 to 190 in quarter one. And right now it's hovering at around 209 as we speak. We expect this to stabilize and taper down as the tapping comes out. And there's a huge amount of rainfall also in the southern parts of the country. Container availability for imported rubber is also an issue right now, so which is leading to speculative activities. We expect this to stabilize by mid of Q2, and hence we don't see it as a very long-term trend, and this spike should stabilize and start coming down.
Okay, what does it mean in terms of margins then? Because margins have come down from close to 15% to around 12%. But to be fair, Mr. Banerjee, you had indicated in your last interaction with us that the first half of the year will be weak and then you expect it to recover. So do you see it recovering in the second half of the year? If yes, should we get closer to around that 14% odd mark?
Yeah, I'd been mentioning that we would like to keep our margins within a narrow band, and we've just fallen a little bit behind of the lower end of the band at 12%. Q2, the raw materials basket is expected to rise by another 5 to 6% over Q1. So Q2, the price increase impact which happened in Q1 also will be felt in Q2. We have to manage Q2 prudently. And thereafter, we expect the pressure to ease out in half two of this year. And we are also seeing a very robust demand in margin accretive areas, which is international sales, two-wheeler sales, rural demand is coming back, and also passenger car tire sales where we have started investing heavily.
Got that. Mr. Banerjee, hi, good morning. Prashant here. So just to stick with pricing for one bit longer, some have made the case that there is there is structural sort of pricing, a pricing strength available in the industry, and you're kind of well capitalized to take advantage of that with your brand, etc. Is that really the case? Right now, of course, prices are going up because you need to, and that's happening with a lag, as you said, and things will stabilize in a quarter or two. But is that are underlying conditions favorable to support slightly premium pricing over a period of time?
Absolutely. The key enabler is the demand situation. I think replacement demand is pretty good. Commercial segment, passenger segment, as well as two-wheeler segment, as I mentioned, the rural demand is coming back. Rural growth is higher than urban growth. So if the demand situation is supportive, we will be able to take pricing up in passenger as well as in truck bus radial, where our products are getting accepted because of superiority in performance, which is being seen by the end customers through repeated trials and efforts over the last few quarters. So we are pretty confident about being able to take price up, but it will happen with some lag.
Okay, very quickly, Mr. Banerjee, you are targeting high single-digit growth, volume growth for the year. At current reckoning, do you believe that you can get to that? And coupled with the price increases, do you think the revenue growth for the year should be in the vicinity of around the mid-teens?
Mid-teens exactly, I cannot say, but definitely double-digit. We are pretty bullish on the top-line growth and in the right areas, which is international. Our order book is absolutely strong. And there's some disruption, as I mentioned, because of container availability and freight rates, etc. But on a long-term period of 2 to 3 quarters or 4 quarters, we are pretty much confident on that front. Our two-wheeler sales is robust. Our four-wheeler sales is going to improve in future. And we have done remarkably well on the commercial vehicles tire sales also. OEM was a little bit subdued for us in Q1. Which is expected to pick up with the new models which are getting rolled out on CEAT tire, and we are nominated on that. So we are quite confident of double-digit growth.
All right, double-digit growth on the top line with the margins headed towards that 14% odd is what you're guiding for. Thanks a lot, Mr. Banerjee. First quarter a little bit weakish, but hopeful of a recovery in the second half of the year. For the time being, we slip into a short break. On the other side, we get chatting with the management of Tata Communications and Polycab. Welcome back. This is Corporate Radar. So let's get straight to our next management. Tata Communications, that's a stock in focus. For quarter one, their data revenue saw 20% growth on a year-on-year basis, while the digital portfolio revenue also saw a 51% growth. Their margins are also improving on a sequential basis. To understand what's the way ahead, we're joined by Mr. Lakshmi Narayan, the MD and CEO of Tata Communications. Hi, sir. Good morning, and always good to see you in. We have the overall growth picture. That's at around 20% odd, but you had done some inorganic growth. So what was the organic growth for the past quarter?
Yeah, so we don't really call out the organic growth. The reason being there are two acquisitions that we did last year. One of them being Switch, which we acquired in May last year. So it's nearly 1 year, 1 full year is already over. And right from the day one of the acquisition, we have been managing the two teams as one single team with one single leader. Similarly, on Kaleyra, which we closed the deal in October, right on day one, we announced an integrated management team of Kaleyra. And Digo, a product that we launched 2 years ago, was doing very well in the market. We essentially brought Digo and this together with single teams. So we really can't distinguish the Digo growth from a Kaleyra growth, because in a go-to-market, we integrated the teams from day one. But having said that, there are a couple of more point-worthy data points to note in our digital portfolio. Obviously, now the customer interaction suite and therefore the entire collaboration and customer interaction suite is a very large part of our digital portfolio. The cloud and security portfolio has grown very well. Our media portfolio has shown a very significant jump on Q-on-Q, as well as on year-on-year, on the back of events pick up in the last quarter. And also, we have seen a fairly significant growth in our connected solutions portfolio, particularly Move. We have seen a good growth both in the MNO segment that we operate, as well as in the automotive OEM segment that we operate. So these are very notable callouts from if you will, the organic portfolio, if you will.
So just to kind of get that point, you don't reveal the breakup, the numbers, but the reason we are asking is that there seems to be some concern that while the inorganic moves that you're making, those are really delivering growth, there's some confusion about what's happening to the organic business and the organic revenue. So going forward, can you...
Yeah. Sorry, I think that's the reason, sorry to interrupt, but that's the reason why I'm calling out individually. So the media portfolio Switch is already 1 year, right? So give or take 1 month, and it's been operating as one. And this quarter, we have shown a good Q-on-Q growth of 9% and year-on-year growth as well. On the only portfolio there has been a blip is in the next-gen connectivity, and that is a customer-specific issue that we saw a blip in this quarter. But last year, we grew the next-gen connectivity very well. The ISO Multi-Cloud Connect product that we launched has seen nearly 40-45% growth year-on-year. And Move platform has shown growth. So I think overall, in cloud and security, we have seen a double-digit growth. So these are all the other portfolios in our digital, which was not influenced that much by inorganic acquisition. So that's the point I wanted to make.
Got it. So basically, organic growth is also, chugging along. No reason to worry over there. Got that point. Let's talk about the data growth.
Sure.
Yeah. Sorry. Yes.
No, I think, they are chugging along, as you said. I think we have to be also very conscious of the macro environment. We all operate in the same space as other players are operating, and people have been calling out the slowness in the macro environment. And that applies equally to us. The only thing I would call out is, despite that, we have achieved good growth and we've been able to give an uptick in our margins, which I think is a commendable performance by our teams.
Sure. So let's just talk about the data growth. The revenue growth there is about 20%. In the last 2 quarters, it was a lot hotter, almost 26, 27%, 28%, I think, as well. So what is, either those quarters were a bit of an aberration and a lucky blip, or a good, blip in terms of a good quarter. What is a more sustainable run rate? And you also mentioned that the environment has been sluggish and challenging. Does it continue to remain so? And on data in specific, what is the kind of growth you can guide for?
We don't want to give any guidance and start a new practice, but I think the environment is still cautious. I think the environment in the US with the elections and expected rate cuts, not knowing when that will happen. So there are these environmental factors. But having said that, our international markets have grown very well. I think in our digital portfolio, the way I see it is, the four pillars of our digital fabric, the network fabric and the cloud and security fabric. So these two fabrics are, I would say, somewhat immune to the macro. And I think we expect that because people look at more cost efficiencies, more global contracts, how can we consolidate global vendors into that? So I think those two, regardless of the macro, should do very well. The customer interaction portfolio is more discretionary because it's more dependent on marketing spend. And so there are two types of interactions with customers. One is on marketing and improving the customer experience on after-sales service. And the other is more about authentication and so on. So that is somewhat dependent on the macro and somewhat cyclical. The IoT fabric, again, is somewhat discretionary because people would want to invest in delivering connected solutions and delivering better connected products to deliver better experience. And that would come under the discretionary spend. So that's probably how you would look at the impact of the macro on our portfolio.
Okay, all right, Mr. Lakshmi Narayan, let's ease you out a little bit. We're not getting too many numbers from you, but let's compliment you on the margins. You have said that in the past that gradually you see margins move towards that band of 23 to 25%. And on a sequential basis, there is some improvement. So tell us for this year, how much, better can it get from what you've delivered in the first quarter? On an average for FY25, what can it be? And by when do you get to that band, 23 to 25?
So firstly, on the 23 to 25%, we said that that's our medium-term target, and we would get there in a couple of years' time. This quarter, we are very, very pleased to see the uptick from the exit of last quarter of 18.5% to 20%. And we anticipate that we will retain at this level and gradually start to improve in the coming future quarters. So because at the increase in margins are on the back of a lot of activity that is going on to bring the benefits of synergies and the programs that we are running inside the company to deliver better operating leverage. But having said that, we are also investing even further in developing more within this platform. So Kalera, for example, as a result of the acquisition, there are some cost synergies that we are working on, but we are also investing in expanding the product portfolio to move beyond SMS to WhatsApp and other channels, and we are building out the software platforms on top. So those investments will continue, and therefore, we would gradually improve the margins. Our focus is to get to the 23-25% in a couple of years' time.
So FY26?
You can say that, yes.
Okay, all right. You also said that you're looking at doubling your data revenue by FY27. The street believes that looks very, very aggressive without any more M&A. So that guidance that you've given of doubling it, does it include some M&A? And if yes, should we hear about something in this fiscal itself?
No, firstly, I just want to correct, it's not a guidance. We said that is our goal, and we set ourselves a fairly ambitious target. So looking back at, our performance over the last 5 years, it's been largely focused on getting our balance sheet right. It's been getting the margin profile right, the operating model right. And having done that, the choices was, we stay there and deliver low growth but high margin, or deliver a faster growth. And in order to deliver a faster growth, and also to become a lot more relevant in the digital journeys of the customers, we had to expand our portfolio, and we have to invest in strengthening our products and platforms. That is exactly what we said we would do, and that is what we've been doing. And last year, we have invested over $600 million in all the capability enhancements, organically and inorganically. So, that's a picture that I wanted to paint, to let you know that we are investing for growth, right? And that's the motion that we're now. And because that we've said that ambition is that, and we are investing, we are already beginning to see that our relevance with our customers are increasing. And it depends on when the macro conditions will improve. We are very well prepared and set up in order for us to achieve the growth targets that we've said we will.
Okay. All right, sir. We will leave it on that note for today. Thank you very much for joining in and giving us some perspective on your business. Well, with that, we'll move on to our next management conversation, and the focus is now on Polycab. Now, the first quarter was actually a miss for the company on all fronts. EBITDA margins were under pressure due to a change in the business mix. The cables and wireless segment saw some good revenue growth, though. So let's talk about the outlook going ahead. We've got Inder T. Jaisinghani, Chairman and MD of Polycab, with us, as well as Gandharva Tongya, ED and CFO of Polycab. Gentlemen, thanks very much for joining in. Mr. Jaisinghani, if I could, come to you for the overall picture, because, I mean, if you look at the first quarter, the year is not off to the good start, because there was a miss in terms of the top line, the margins. I mean, I'm talking about analyst expectations over here. So can you tell us what the environment is like for the cables and wireless business, as well as your FMEG business, where the good news is that the losses seem to be reducing and, things are looking better?
FMEG now it is growing because we are increasing our network, and already we are bringing with the new varieties and capturing right market. But it will take further time. But we are at least at par now, and we are coming to this year in the profit, and it is going to grow continuously at a 20-25%.
That's FMEG, sir. So 20-25% growth on your FMEG business. Profits this year will turn profitable. We got that. Just start with the headline on the basic business, cables and wires. What's happening there?
Cable and wire business also is good, but because of today, depending upon because of volatility of the market, and all dealers distributors are trying to reduce their stock, but overall demand is good from both the point of view, dealer network and the infrastructure. There is a good demand, and I think so continuously it is going to grow. There's no short of any demand.
Okay. All right. Good morning, gentlemen, and good to see you. When the last reported market share that I have is around 25% in the wires and cables business. And it appears, in comparison to the other listed peer, you have grown faster. So have you gained market share in the first quarter?
Yeah, we are.
Yeah. Thank you, Inder. It will be difficult to make that statement at this stage because the other listed companies have not yet published their numbers. But it seems that we are continuing with our growth trajectory, and this year also will probably end up having some gain in market share.
Okay, good on that. Just one more quick point before we get into the nitty-gritties is that normally I'll mention that Project Leap, which had that target of around 20,000 crores odd. But I think in yesterday's presentation, it was missing. Are you coming out with a fresh guidance? 20,000 crores in this year, and 2026, it looks even better. Before your analyst call, I want to know about that because that was a notable miss yesterday.
Yeah. You are perfect in your detailing. You're right. So in 2021, we embarked on this particular project. This is a transformation project, and its name is Project Leap. BCG, or Boston Consulting Group, is helping us on this project. And under this project, we wanted to attain a top line of 200 billion or 20,000 crore rupees by fiscal 26. And as you know, in the last year, fiscal 24, we had achieved almost 18,000 crore rupees of top line. So in the current fiscal, we'll recalibrate our guidance because 20,000 crore rupees we should be able to achieve sooner than FY26. And between second quarter and third quarter, we should be able to come out with the revised guidance.
Okay, but 20,000 crores looks like maybe you'll get to it in this year. Don't you think it's possible?
I think what we can certainly do is we will continue to grow at a rate which is going to be better than the industry growth rate. And if that happens, it's quite possible that we are able to achieve 20,000 crore rupees top line before the FY26 deadline.
Okay. And what about margins, Gandharva? The dip that we've seen this quarter, I'm just going back to the headline margin number. So you're at 12.4 versus 14%, 14.1% last year. Now, is this a temporary blip? How do you make up for it? And how does the rest of the year look?
You're right. In fact, last year we had a dream run. We had almost 30 to 40% volume growth. The top line grew from 14,000 crore rupees to 18,000 crore rupees. Even the EBITDA as well as PAT margin expanded. The PAT margin was almost 10%. Against that great performance, even the current year, we have started with a positive growth. The top line grew by almost 21%. This is again the best ever first quarter performance of the company. And as you rightly noticed in your opening remarks, there is a change in the mix. The EPC business, which used to contribute almost 3% to our top line, in this particular quarter has registered growth of 292% and contributed almost 10% to our top line. Historically, EPC business is a less margin business than our cable and wire business, and that is why the blended margin has contracted to 12.4%. The other two reasons why there is contraction is the exports business registered a bit of a degrowth, and exports margin is comparatively better profit business than our domestic business. And the third is the channel business registered a bit of a degrowth in the month of June, and the institutional business in domestic market registered a very solid growth. So because of these changes, there was a mix at the company level, and that is where the contraction was noticed. In general, we are comfortable having a EBITDA guidance of 12 to 14%, and this quarter also it was within that particular range. We believe that in the quarters to come, we should be able to maintain and improve on EBITDA margins.
No, but 12 to 14% is still a band, and I'm trying to understand whether, realistically speaking, whether you will be at the lower end of that band because of all the factors you mentioned. It's not just one factor. Mix is just one issue. Lower exports and the channel issue that you spoke of. So how many, out of these three issues, which ones do you think will start reversing, whether the cables and wireless growth comes back enough to ensure that you remain closer to 14%, the top end of that margin guidance band?
So as far as the domestic cable and wire business is concerned, it is dependent on volatility in copper prices. In this particular quarter, there was a fair amount of volatility. Copper moved from close to $9,000 to almost close to $11,000. And yesterday it was hovering around 9,300, 9,400 levels. So if that volatility continues, it might have some impact on the immediate term basis. But if we were to take a mid-term view, we believe that we will continue to grow at a rate which is going to be better than the industry growth rate. And in that case, we should be able to operate at the higher end of the EBITDA margin guidance of 12 to 14%.
Okay, all right. So you're maintaining that. And just to reconfirm, if you have to revise your guidance, it will be done in the second half of this fiscal, right? Quarter 3, quarter 4, if in case you want to revise it.
Yeah, we will certainly revise the guidance and we'll try to do it at the end. But safer to assume that we should be able to do it in the second half for sure.
Mathematically, that guidance actually is not very material right now, just mathematically, but you all know how business is trending on ground, so you'll be the best judge on that front. But you mentioned the international business, which has degrown more than 25%. And I think the contribution has come down to around 5.5–6% odd. Earlier, you all had guided that, say, by the end of this year, it moves to around 10 to 12%. Do you maintain that guidance that things recover from here on? And by the end of this year, we'll still have 10% of your total revenues coming in from the international business?
You're right. Our guidance till fiscal 26 is to have 10% exports contribution to the company's top line.
Yes.
You are right that in this particular quarter, there was slowness and sluggishness, which was noticed. This was predominantly coming from a particular geography. Outside that geography, other geography has registered growth. And we believe that in quarters to come, we should be able to move towards 10% guidance.
So you believe that things will recover then from here on, right?
You're right.
Okay, all right. Any update with regard to the conversations you all were having with the tax authorities? That was a bit of a blip that you all saw late in December, but the market seemed to be in that sort of a mood that they bought that dip and the stock price is much higher. Stock price aside, have you heard from the tax authorities?
So we have not received any demand or any notice from the income tax department, alleging what was stated in the PIB release. We are in discussion with the income tax department. We have been told that this is a time-consuming process, and as and when we receive any notice or any further communication, we will continue to notify the stock exchanges as we have done over the last several months.
Any timeline indicated?
This is a government-led initiative, and there are timelines under the Income Tax Act. I've been told that in general, they should be able to wrap up such exercise within the 12 months of the end of the fiscal in which the search was conducted. That means that by March of 25, in general, the department should be able to conclude. But these are government timelines and they are dependent on several ifs and buts.
No, but that it's still helpful and appreciate you being candid about it. It just gives investors an idea about sort of what time frame to work with, because this is still an open issue. There is no statement from the tax department saying that there is absolutely no demand. So it's still sort of lying open. Just to talk about, some final issues, let's get back to Mr. Jaisinghani as well. Sir, you were in the midst of a big CapEx rollout plan. What are the capacity utilization levels right now? How much more capacity would you be adding? And in terms of top-line growth, what is the further impetus we can expect with this CapEx coming on stream in FY25 and FY26?
Basically, today we are capacity utilization around about 70 to 72%, and continuous demand is there, and a lot of variety we are adding in our cable line. Special cables, we are coming with the EHV cables, we are coming with the which is required in the electricity board, MECC cable, aerial bunch cable. So a lot of new variety also we are going to make it. So we are continuously putting in a capex, which is going to be give us at least 20-30% more coming time our revenue, and with the good reasonable profits.
Okay, all right. Final question then, Mr. Jaisinghani, before we let you go. The promoter holding, a couple of years or so ago was around 68.5%. It's come down a little sub that 65% because of that small stake sale that we saw in the month of June. What's the plan? I mean, you're still very much in control of the company, but since the stock price has moved and you would have worked very, very hard to build the company, do you believe that you could sell a couple of more percent, given that demand is so strong for your stock, and you could take some money off the table?
No, we are sometime require in a family something which is the family has to decide. So we had decided whenever we see that the right time in coming 3-4 years, we are doing sometime in 1-3-4 years. But that we are together thinking very clearly that what we have to do, what required for our family. That's all.
Okay. So it was a family requirement. That's why you sold that 2% odd. But is there a plan that there could be some further requirement where you could bring your stake down by a couple of more percent, say to around 60% or thereabouts? Could that be a part of the plan?
No, that is not in our mind at all.
So as of now, no more stake sale from the promoter.
Okay, we got that. That's a no that we have noted and registered. Got it, Mr. Jaisinghani as well as Gandharv. Thank you very much for joining in and taking questions today. So that's Polycab with how they're viewing the business going forward, saying that the FMEG business will be profitable this year. It already, at the EBITDA level, it's already looking better in the first quarter, and they're expecting to hold margins towards the higher of that band of 12 to 14%. 20,000 crores in revenue is the target for the current year as well. Stock is doing well, but the market really isn't. Check out the screen now. The mid-cap slide has expanded. There's a 1.4% drop at the index level. The advanced decline ratio is very negative. 1,800 stocks down now. Just about 440 stocks on the upside. And even the large caps are feeling the heat. Pull up something like TCS, which is sort of barely positive. Look at Infosys, which is still retaining a 3.5% up move. But a lot of the other tech stocks are seeing profit taking. Case in point would be a Wipro. Look at a Tech Mahindra. These are some of the stocks on the way down. So good time to bring Mitesh back in as well. Mitesh, profit taking going on as we see things. What's your advice for now? Index level stocks, what to do?
Surabhi, I think yes, some sort of profit taking at least is happening, especially in sectors like metals, two-wheelers, etc. And I think that's where some weaknesses can be seen. IT today is reacting like a misbag, but FMCG is doing good. So I think we'll approach the market that way. On the Nifty per se, maybe levels of 24,550 on this spot could be the support area. So we might in the next 1-2 days head towards there as we also run into the budget event. Some profit booking can happen. So we'll keep a watch at 24,550. But on the Nifty, I said in the morning around 24,950 take profits, but we didn't get those levels. But even now, I think exiting may not be a bad idea. It does look like a heavy market. Having said that, I have a sell on JSW Steel. Keep a stop at about levels of 925 and look for targets of 880, 875. Sorry. And a buy on Coforge with a stop at about 6,000 for targets of 6,350.
Okay. All right, Mitesh, thanks very much. Got that. We'll come back to you during the course of the day. Let's see how it progresses right now. About a 90-point drop on the Nifty. We'll take a break, come back with a lot more on the other side, a lot of the stocks that are making headlines this hour. Welcome back. Well, let's focus on a couple of stocks that are making the headlines. Market overall is, of course, down. Let's look at Persistent Systems because that stock has sold off quite a bit after the first quarter numbers. Reema, what has gone wrong?
Well, you know, growth for Persistent is very strong, but the street is a bit concerned about the margin performance. So we told you about the reported margins. Reported margins were also a miss. They declined by 40 basis points to 14%. But you know, this reported number of 14% has certain one-offs. One-offs related to reversal of earnouts, incentive structure, there is a change in the depreciation policy, etc. Now, according to one of the analysts, the adjusted EBIT could be as low as 9.5%. Now, everyone's calculation is a bit different. I tried to reach out to some more analysts. Not everyone's on board with this 9.5%. But the key takeaway is that this margin number has got some one-offs, and therefore the actual adjusted margin would be lower. That said, the management in the conference call was today morning at 8 o'clock. They said their endeavor is to, grow well and keep the margins in FY24 similar to last year. Another point to note is the strong outperformance of the stock. Since June, which is when the IT rally began, Persistent is up 35%, while the Nifty IT is up 24%, and valuation premium of Persistent has also shot up. Back to you.
All right, got it. Thank you very much. That explains the stock reaction. It's a pretty sharp reaction on the way down. Persistent, but disappointing this quarter. Let's move on to JSW Infra. We're again talking about a result that has missed expectations. Vivek, what are the issues here?
Well, it's a soft start as far as JSW Infra is concerned for FY25. Analysts on the street were penciling in a volume trajectory in the range of 30 to 31 metric tons. And in fact, consensus seems to have missed the fact that there was a shutdown, a maintenance shutdown as far as JSW Steel's Dolby plant was concerned. On the back of that, the volumes that have been declared have come in at close to 28 metric tons. So looking at the actual numbers, revenues higher by 15%, EBITDA down 6%, and margins at 50%. The effective tax rate this particular quarter was higher. That also impacted, the entire P&L. Profitability down 7.2% on a year-on-year basis. Now, what is the good part of the result? The good part of the result was that the third-party market share has actually risen to 50% in this particular quarter, versus, just around 37% in the quarter gone by. Now, what impacted the volumes? The one-off, as well as, there was another issue. Dharamtar as well as Jaikar port volumes were actually lower this time around. What aided the volume trajectory? There was incremental volumes seen from the acquired assets, as well as increased capacity utilization at Paradeep Iron Ore and Coal Terminal. Brokerages are mixed, while Kotak has a slightly negative stance with a sell rating. BNP Paribas believes that given the fact that the company has acquired new assets in the form of Navkar Corporation, there is a possibility that Q2 and H2 can actually be quite strong, and the company will be able to meet, and in case the performance is quite good, it may be able to even beat its own volume guidance given.
All right, Vivek, thanks very much. We'll leave it on that note. Let's take a break right now. We'll come back on the other side, and then it'll be time for our special segment. The budget countdown has begun, and Lata will have with her Manish Sabharwal, Vice Chairman of Team Lease, on what the budget can do for employment generation.
Today in our pre-budget series, we asked what can the budget do for job creation. Now, employment numbers have been confusing. The latest CLEMS data from the Reserve Bank, which is based on the periodic labour force survey data, shows that the number of jobs created went up sharply in 2021 and 22. Remember, both COVID years. The CLEMS data also shows a fall in labour productivity, which means quality of jobs is probably the problem and not number of jobs. Today, I have with me someone who has immensely contributed to the formalizing of jobs. Manish Sabharwal, Vice Chairman, Team Lease, a company that has hired 18 lakh employees in the past 15 years. Manish is also a member of the National Skill Mission. So thank you very much, Manish. I can't think of a person better placed to speak to the government and to us about employment creation. Also, kudos for an excellent article in the Mint. So let me start. What should the first thing the budget do for formalizing jobs and indeed employment creation?
I mean, if I recognize the budget as a financial statement, the biggest gift it can give is macroeconomic stability. I think we sometimes take that for granted. So I think the notion that I think we have oversold fiscal and monetary policy as a way to create jobs. You know, if fiscal deficits could make countries rich, then no country would bother being poor. So I think the biggest gift that the government can give is just macroeconomic stability, and obviously the steady shift from capex, from revenue expenditure to capital expenditure. I mean, the 10 lakh crore last time was a new milestone, and I hope we'll sort of keep recognizing that productivity is our challenge. And that goes back to the question that you raised of why are we having this debate? Are both sides right? And I think both sides of this debate are right. Unemployment has never been a problem since 1947. Our unemployment has been between 6 and 9%. Our problem is employed poverty. Now, what can the budget do about employed poverty is a really important question. Most people will say that employed poverty is about structural reforms or structural transformations, you know, moving from farm to non-farm employment, moving from informal to formal. So my sense is that the budget, we should not expect it to do sort of institutional reforms or capacity building reforms. Those are multi-year reforms, but it can do flick of pen reforms. And so there are a bunch of flick of pen reforms, whether it is going to a single labor code, whether it is reforming the social security system, whether it is making the Jan Vishwas Bill 2.0. Jan Vishwas 1 was a great innovation, but it was only 100 out of the 20,000 plus criminal provisions for employers that were removed. So there's a lot of daily life of employers. So I think if the budget shifts from this bird's eye view of employment to the worm's eye view of employment, what is the daily life of employers, that would be the biggest gift.
Oh, that's two excellent things that you've said. So let me go, word by word. The flick of pen and worm's eye view. Now, the flick of pen, let's start with this Jan Vishwas itself. What can it announce? You said 100 employers' acts were decriminalized. Many more need to be done. How should they do that?
So there are 25,000 ways to go to jail for employers in India. And that list is way too long. It is way too random. And basically, no, you don't put CEOs in jail, right? So there are transmission losses between how the law is written, interpreted, practiced, and enforced. So Jan Vishwas 1 was an innovation. You know, we haven't ever had a targeted decriminalization. But I think because of the way it was done, which was asking ministries or departments to surrender their criminal provisions, nobody cuts the tree they're sitting on. So I'm hoping Jan Vishwas Bill 2.0 really what I call reverses the gaze. The government will decide these are the 5 ways that you should go to jail, and all departments should remove provisions that don't mean. You know, it's very obvious there's established jurisprudence, harm to others, fraud. There are 4 or 5 reasons why which things should be criminal. You know, not filing a challan should not be criminal. Not putting chuna in your bathroom should not be criminal. I mean, these 26,000 ways are just randomly ways to go to jail. And combined with the fact that nobody goes to jail, if somebody steals Provident Fund, they should go to jail. Yeah. So I think that let's have less provisions, let's enforce them better. So I'm hoping Jan Vishwas 2.0 really takes this 26,000 number, of which 50% is with state government. So really only 12 to 13,000 are with the central government. Takes it to the next level of saying that, look, we are moving to a different regime where we will have fewer criminal provisions. We will enforce those criminal provisions, and we will be clear, because currently it just encourages corruption and informality. What is informality? Fair. Informality is a sense of humor about the rule of law.
Okay. Well, let me come to the more important thing, which perhaps all of us have felt. This social security appropriation, which the government does, or which employers are forced to do, EPFO, ESI, etc. Many of us are not able to get the pension money of our previous jobs because they are lost. You know, there was a time of pen and paper. You have a very strong view against it. If you can explain that in detail.
Well, I think mandatory payroll confiscation is not a source of financing. In a world of cost to company, benefits come out of salary. They don't come over and above salary. Unfortunately, these laws are written by civil servants whose views that benefits are over and above salary. That was corporate India 25 years ago. Now CFOs have no other pocket to pick. All employee costs go to one cost head. This is very important from a worm's eye view, because at every job fair that we go to, the kids say, "Haath wali salary or chitti wali salary?" And 35% of salary has to be confiscated for kids with less than 21,000 rupees per month wages. While if you have 30,000 or 50,000 rupees a month, I only have to confiscate 5% of your wages. So it's a funnily regressive thought world of the legislation that benefits will be paid over and above salary. Actually, what happens in the real world is that CTC is an agreed upon number, and then benefits come out of that. So and also this system is so inefficient. EPFO is the world's most expensive mutual fund. It charges 400 basis points. Most mutual funds, especially gilt weighted mutual funds, charge 25 basis points.
Yes.
So it's not only expensive, it's inefficient. There are 100 million EPFO accounts, but only 50 million pay every month. The other 50 million are dormant accounts like yours. Lata Venkatesh was Lata V, then it was V Lata, then it was, we all, in a pen and paper world, we had multiple ways which our name was written. It's not linked to Aadhaar. So I think that unless we stop this 35% salary confiscation by making employee provident fund voluntary, because employee provident fund, which belongs to the employee. I think employer provident fund, I don't mind, because the optics of reducing employment provident fund are so difficult. Make employer provident fund from 12 to 13%. But reduce employee provident fund, make it voluntary, create competition for EPFO, let us pay to NPS, create competition for ESI, let us buy any IRDA health insurance program. I think you will see at least 30, 40, 50 million people move into formal employment. And why I obsess about formal employment is employed poverty. Because the only way we're going to get out of employed poverty is wages being paid by high productivity employers, and formalization is a proxy for high productivity. Formal employers have access to credit, they have access to training, they have access to better employers. Right now, we're stuck in this low-level equilibrium where out of the 63 million enterprises in India, only 25,000 have a paid-up capital of more than 10 crores. So if you don't have pay the wage premium, you'll never have the productivity. But if you don't have the productivity, you can't pay the wage premium. So I think it is very unfortunate when people focus on the problem as jobs. Because if you think the problem is jobs, you'll throw money from helicopters, you'll mandate 3-day work weeks, you'll take away people's JCB and give them spoons to dig with, which is, I'm worried about this budget because some of the wrong narratives, or at least in my mind, the wrong narratives are that welfareism was not done enough. Actually, my reading of this election results is welfareism may be running out of its course, and the only tools you have are jobs and skills.
No, you may be right, because there is a race to the bottom now that state governments have started preparing for their elections. There is a genuine fear that this welfareism is getting out of hand. Manish, that's very important. I didn't know 21,000 salary below 21,000, 35% is appropriated and much less for above. This is, absolutely an eye-opener. And I hope this flick of the pen happens in the budget. But, on the larger issue of, job creation or employment creation, this capex, even construction these days, even road construction, is not as labor-intensive as it used to be. So how do you make manufacturing labor-intensive? Do you think PLIs should focus on how many of jobs created or labor-intensive industries?
I think, we'll never get to the 45, 33 or 28, which were the peaks of the labor force of Britain, UK and China. But 11% of manufacturing jobs is the wrong number. So I think clearly single labor, and I think that 50% of India's foreign direct investment since 1947 has come in the last 5 years. But the 40 factory refugees, I hope Xi Jinping doesn't get a 4th term. I hope he gets a life term, because he is our biggest ally in fact, manufacturing jobs. But they have moved skills and infrastructure in their mind from a dagger in the heart to a thorn in the flesh. I think the only dagger in their heart now is the regulatory cholesterol, which obviously is around Social Security, but is around the criminalization, around the labor laws. So I think we have such a unique opportunity to create manufacturing jobs. The PLI is really a bribe to, people to shift their factories from China to India. I think we should try that. We must recognize that, it has the potential to get out of hand if you keep expanding it to multiple sectors. I mean, 2 lakh crores, 3 lakh crores, 5 lakh crores is the max that we should make the total allocation to PLI, because the challenge with these kind of schemes is that every scheme sort of every industry, every company will try and rebadge itself to take advantage. Absolutely. So I think PLI shifting from investment and output to employment is obviously a good idea. But I really think the role of the government is not to set things on fire. It is to create the roles of spontaneous combustion. If we can create the conditions for spontaneous combustion and, moving to labor codes, you can't comply with 100% of India's labor laws without violating 10% of them. There's 17 definitions of workers. There's 22 definitions of wages. So there is no way that you can operate across this country in multiple industries without sort of having some labor inspector show you how you're violating the labor laws. So instead of 4 labor codes, a single labor code, a move to simplicity. I mean, you can't idealize China moving 700 million people from farm to non-farm employment without recognizing that it was a fertile habitat for employers.
Yes, fair point. What combustion did you say it is?
Spontaneous combustion.
Okay, spontaneous combustion. Now, that's sounding pretty close to Shashi Tharoor, okay? But anyway, those are very great ideas and don't require much expenditure. It's more in terms of changing the law, or as you say, a flick of the pen that itself can formalize a lot of jobs or create the environment for more formalization of jobs. Manish Sabharwal, always a pleasure speaking with you, and we hope we can have you on Budget Day as well.
See you soon. Take care.
Thanks a lot for that. Now, I have a couple of more minutes before I can wind up this show. So let me point your finger at a very important, much-awaited Reserve Bank paper on what is the natural interest rate for India. Now, they have put out that paper on the website yesterday in the bulletin, and it says that India's natural rate is currently 1.4 to 1.9%. Now, why am I saying this is important? All economists want to know what is the natural real rate. Now, the natural real rate is the difference. First of all, the real rate is the difference between the nominal interest rate, which is the repo rate, minus 1-year inflation, current inflation. So, now, according to the Reserve Bank, the nominal interest rate is the repo rate, 6%. The 1-year inflation, next 1-year inflation that Reserve Bank calculates is 4.5%. So the difference between the two is the real rate. What it means is if you get, say, 6.5% for your money, but inflation is eating away 4.5%, what is the real money you have made? Only 2 percentage points. That is the real rate. Now, what is the natural real rate for India? The rate at which growth is at potential and inflation is at target. That is the natural rate. And the Reserve Bank has calculated with various models that the natural rate for India is at the moment 1.4 to 1.9%. Now, what this means is 1.4 to 1.9, the midpoint would be about 1.7. So if inflation is at 4.5, add 1.7 to it, about 5.75 to 6 is the maximum we can expect the rate to fall to when inflation goes to 4%. That is the message. So not very deep rate cuts are there. When the repo rate is way above the natural rate, it means RBI is trying to tighten, which is what it is trying to do now because inflation is at 5.08. That's the current latest inflation number. When it comes to 4, it will keep the natural rate at 1.4 to 1.9%. Now, the other thing that the Reserve Bank points out is potential output. What is the potential output growth of the economy? The natural rate of growth. It says that in Q4 it was 7%, and the potential output growth at the moment lies again in a big band between 5.9% and 8.3%. There is not much explanation for why such a wide band, but I suppose it's all because of statistical uncertainty and because of the kind of world we live, climate changes, etc. So India's potential output growth is a wide band, lies somewhere between 6 and 8%. A little north of 7%, perhaps, if you take the midpoint. Now, why is the natural rate wide? the Reserve Bank paper lists several reasons. First is there are 4 ways of arriving at it. So each model gives you a different number, and therefore this wide band. By one model, they get 1.4. By one model, they get 1.9. And then there are measurement issues. There are estimation issues. You know, statistical estimation is always an approximation. So the paper points out that, for instance, they had calculated the natural rate during the COVID period, that is Q3 of FY22, October, November, December of 2021. They had estimated it at 0.8 to 1%, the natural rate. But then later on, we got a higher GDP number when it was revised. So then the natural rate has got revised up for that period to 1.2 to 1.4%. What determines natural rate? It's, you know, long-term things like dependency ratio, demographic advantage, how many people have aged, what is the persistent fiscal deficit. All this go into creating or calculating the natural rate of interest. In India, the natural rate is likely to rise because there is a rising demography, young demography. They will save more, invest more. You need more capital investment for them. You can see the capex growth in the Indian budgets. All this leads to a higher natural rate. That's the sum and substance of the paper, but it is very important, and you will see it being quoted repeatedly by economists when they assess the Reserve Bank's monetary policy. With that, I'll wrap up this edition of Bazaar. Chartbusters.